If you have a side hustle, you lost money to the IRS last year that you did not have to lose. 5 things you have never been told are silently working against you every tax season. For centuries, sailors followed maps that showed monsters at the edge of the ocean, stayed close to the shore, took a long route, burned through supplies, lost months at sea. The open water was never dangerous. The map said it was. Then someone sailed straight through and found a shorter route that was there the whole time. Your side hustle taxes work the same way. The route you have been following has wrong turns baked into it. They look normal, everyone around you is making the same ones, but each one burns money you did not have to spend. Hi, I'm Mia, certified CPA. Today I'm handing you the real math. We're counting down from 5 to 1. And number 1, that is the turn that takes a $500 problem and drive it straight into $3,000. But first, 30 seconds on why the IRS is suddenly paying attention to money they used to ignore. The baby monitor. Why the IRS can see everything now. Think of it like this. You know how new parents set up a baby monitor? They put that little camera in the nursery and suddenly they can see everything, every movement, every sound, 24/7. Before the monitor, the baby could be wide awake at 3 in the morning and the parents had no idea. Out of sight, out of mind. And that is exactly how side hustle income used to work. Cash jobs, someone paying you through PayPal for freelance project. The IRS could not see it. So most people figured if they do not see it, I do not need to worry about it. Then the IRS installed the baby monitor. How big is the problem? The IRS estimates that Americans underpay about $696 billion in taxes every single year. That is the tax gap, and the biggest chunk of it, over 77%, comes from underreported income. Your side hustle sits right in the middle of that target. So that side income you thought was flying under the radar, the IRS has been watching it sleep. The crackdown is not happening because people are suddenly making more money on the side. The platforms just made everything visible. And once the IRS can see it, the rules start applying whether you knew about them or not. Now let's talk about the 5 mistakes. Mistake number 5, not tracking income and expenses through the year. Most side hustlers treat tax season like a scavenger hunt, digging through receipts and bank statements in March, scrolling through Venmo history, trying to remember what that $400 charge in June was for. Sounds familiar? When you piece together a year's worth of income and expenses in one weekend, things get missed, deductions disappear, and numbers get rounded, and the picture you file looks nothing like the picture the IRS already had. What is that filing looks like when you have not tracked anything all year? The IRS has their numbers. The platforms gave it to them. If yours does not match, that is not a misunderstanding. That is a flag, and the numbers back this up. The IRS found that 55% of income from sources with little or no third-party reporting goes unreported. 55%! That is not a rounding error. That is more than half the money disappearing off the books. And sole proprietors, which is what most side hustlers are, sit right at the top of that list. The fix is boring, and this is why it works. Track your income every month. Log your expenses as they happen. A simple spreadsheet is enough. Even a note app on your phone works. The people who get hits with surprise bills in April are almost always the people who wait until April to look. Mistake 4, mixing personal and side hustle money. If I look at your bank account right now, could you tell me which deposits are W-2 income and which ones came from your side hustle? Most people cannot. Everything lands in the same account. Groceries, rents, client payments, equipment purchases, all swimming together in one big pool. And when everything is in one place, 2 things happen. You miss deductions you actually earned, and you cannot prove the ones you claim if the IRS asks. Imagine Uncle Sam knock on your door one day, sits down at your kitchen table, opens a folder and says, "Show me which of these transactions were business expenses." Now you are scrolling through a checking account with 800 transactions on it, trying to explain why the Home Depot runs in September was for your side hustle and not your bathroom renovation. Good luck with that. A separate account changes the entire conversation. Side hustle income goes in one place and business expenses come out of that same place. That's clean, traceable, and if Uncle Sam ever does sit down at your table, you'll slide the folder across to him instead of the other way around. Quick check. Before the top 3, do this for me. Open your bank app. Look at your last 3 months of deposit. Can you separate personal from side hustle in under 60 seconds? If the answer is no, you just proved at least 2 mistakes on this list yourself. I made a free side hustle tax checklist that walks you through every deduction most side hustles miss. Link in the description. Grab it. Now, the top 3. These are the ones that change the size of your bill. Mistake number 3, treating cash and payment apps like they're invisible. If someone pays you $200 $200 in cash for a job, or send you money on Zelle, or Venmos you for a project. And in your mind, that money does not exist on paper, feels invisible. But here's what actually happens. That cash gets deposited, the Zelle transfer shows up in your bank records, and the Venmo payments, the IRS has that data now. Remember the baby monitor, the one the IRS installed? It watches the patterns, unexplained deposits, lifestyle that does not match reported income. The IRS does not need a receipt from your customer. They just need your bank account to tell a different story than your tax return. And when those two stories do not match, you are the one who has to explain it. And I want to say something that might make some people uncomfortable. Most CPAs have never explained any of this to their clients. The average tax preparer takes your numbers, plug them into the software, and hands you a bill. They do not sit down with you in January and say, here's how your Venmo income works, and here's what the IRS can see, and here's how to protect yourself. And the people paying for it are the ones who trusted that someone was watching out for them. Mistake 2, waiting for a 1099 that might never come. Let me ask you something. If your landlord forgets to send you a rent invoice, would that mean you do not owe rent this month? Obviously not. The bill exists whether the paper shows up or not. And that is exactly how 1099s work. The form is not permission to report your income. It is the confirmation of income that already existed. The IRS calls it an information return. Its only job is to make sure what you reported matches what the payer reported. And here's a number that will wake you up. When income is subject to third-party reporting, only about 1% go unreported. When there's no reporting, that number jumps to 55%. The IRS knows this. That is exactly why they have been expanding reporting requirements. They're closing the visibility gap. Some platforms send 1099s late, some never send them at all, and some people never bother to download them from the dashboard where they have been sitting since January. Meanwhile, the IRS already received the copy. The matching software already logged it, and the clock is already ticking. I had a client who did not get a 1099 from a freelance platform for 1 year. She assumed it meant the income was too small to matter. 9 months later, the IRS sent her notice adjusting her return and adding the full amount as underreported income, penalties included. The form is not what makes the income real. The money hitting your account is what makes it real. Report everything, even if the paperwork never lands in your mailbox. Now, we're at number 1. This is the one that costs the most, take the longest to fix, and is the one almost every side hustler has either done or is doing right now without realizing it. Mistake number 1, not reporting income you assume the IRS cannot see. You made some money on the side, maybe a few $1,000s, maybe more. You look at the number and think, that is too small for the IRS to care about. For a while, nothing happened. The IRS never called. The return got accepted. Life moved on. But the only reason the IRS did not act is because they did not see it. Now they see it. Every platform, every transaction matched automatically against what you filed. The IRS called this their automated underreporter program, AUR. A computer compares what third parties reported about you to what you put on your return. If the numbers do not match, it does not call you to have a conversation. It sends a letter with a number on it and a deadline attached. Size does not protect you anymore. $1,000 unreported triggers the same automated flag as $50,000. The computer does not weigh how big the amount is. It only measures whether the two numbers match. And here's where it really stinks. Let us say you made $6,000 from your side hustle and you had $4,000 in real business expenses. Your actual taxable profits, $2,000. About $500 in taxes. But you did not report any of it. So the IRS sees $6,000 in income and $0 in deductions. Now the bill is $1,500 plus penalties and interest. And you are scrambling to prove expenses after the fact, under pressure, probably paying someone to help you clean it up. That $500 problem just became a $3,000 problem. If you just did that math in your head with your own numbers, the answers make your stomach drop a little. And that is the exact feeling that brings people to HavenStone. We untangle it, we rebuild it, and we make sure next year looks completely different. Link is in the description whenever you're ready. The real cost that I see every day. Remember the baby monitor? Before the IRS installed it, side hustle income lived in the dark. People made money, keep it quiet, and move on. The system was not built to catch it. Now the monitor is on, and it is not going off ever. The side hustlers who are thriving right now are not the ones making the most money. They're the one who adjusted to the camera being there. I see two types of people that I talk to. The first type shows up after a letter arrives, stressed, angry, confused about how the IRS even found out, scrambling struggling to reconstruct a year's worth of expenses from memory and old bank statements. By the time we untangle it, they have spent more on the cleanup than the original bill would have been. The second type shows up before any of that happens. They track their income, they separate their accounts, they report everything, and they claim every deduction they are entitled to. Tax season for them takes about an hour, maybe two, and they keep more money at the end of the year than the first type, even though they reported more income. One group reacts, the other designs. The Treasury Department estimates that improved reporting and enforcement could recover over $7 trillion in unpaid taxes over the next decade. $7 trillion. That money is coming from somewhere, and if your numbers are not clean, you're an easy target. The people who survived this shift are the ones who got organized before the letters started. The IRS is not going after side hustlers to be cruel. They can finally see the money. So you have two choices. Keep doing what you have been doing and hope the math works out. Or get organized, get clear on what you actually owe, and start keeping the money you have been accidentally giving away. The old map has monsters in it, the real one has a clear path. And if you want help building the real actual plan, that is what HavenStone exists for. We sit down with you, look at your full picture, and build a strategy that fits your life. Not a template, not a generic checklist, a real plan built around your income, your goals, and your family. Link is in the description. And one more thing, if you want to see another place where small decisions quietly turn into big tax consequences, check out my next video on the 2026 HSA changes. That video breaks down how HSAs can become one of the most powerful tax tools available and how upcoming rule changes could dramatically increase their benefits if you use them correctly. It connects directly to everything we just talked about. So see you in the next one.